topic of my talk. Is my return target realistic? Nat already helped himself to claiming that the elections and politics was the most popular topic we've been asked about, so I guess I have to settle for second place. But I can promise you that this is a topic we've spent a lot of time on with our clients over the last 2 years, 2 or 3 years. And I think a lot of you have probably been through this exercise already, or at the very least, you're contemplating an adjustment to your target rate of return. So that's why we're here. We thought it would be a good wrap-up to all the topics we've talked about, to leave you with some final thoughts and guidance around this topic, because there's no easy answer. In terms of agenda, we're going to talk about why we're here. We're going to talk about what the capital markets have done over the last 20 to even 30 years to put us in this position. We're going to talk about this real rate of return. When we talk about this target rate of return, you can break it out into different components. We'll look at some changes over the years and why that's driving this discussion today with our clients. Ultimately, this comes down to a decision, a choice that clients have to make. Now, a lot of the comments that I'm going to make today are targeted perhaps a bit more towards pension funds than endowments or healthcare organizations. But at the end of the day, the takeaway about this target rate of return and having to drop it, it's not a favorable outcome. If you're a pension fund, specifically a Taft-Hartley or a public pension fund, when you change that target rate of return, that changes the discount rate used to value your liabilities for your plan. That often results in higher liabilities, higher contributions. If you're an endowment foundation plan, you drop that target rate of return, there's probably going to be some impact on the spend rate, okay? So there are really two choices with what we have with this target rate of return. You can either drop your target rate of return because expected returns have dropped. That has negative consequences. Or maintain your target rate of return, you have to up the volatility or really have more risk assets in your portfolio. Of course, that's more volatility. We're going to talk about some portfolio implications of either one of these options. And last, but certainly not least, leave you with a few, hopefully mitigating solutions and guidance around this topic. Kelly mentioned on her talk that the average investor has access to 174 different newspapers with a smartphone, with a computer. Chances are, these headlines have appeared in every one of those at one point or another. And like a lot of things in the institutional investing world, headlines become trends. As trends emerge in the industry, guess who gets asked about it first? The investment consultant. And then guess who the investment consultant goes and talks to? The director of research. So all this comes to me. But this is great because then we can work with different clients and develop some broad guidance. Okay, so it's been in the press a lot. Let's look at one more issue here. This further supports this trend. What we're going to do here is look at the distribution of expected returns for pension funds. This is an annual survey that JP Morgan does. There are a number of different institutions that do this. We chose the JP Morgan data. Here is the return distribution in 1999 of pension funds. Now, if I were a millennial, I'd have some witty joke about we're going to party like it's 1999. I'm an actuary. You don't get that from me, so my apologies. Let's fast forward this now to 2015. Look at that dramatic change. The averages are at the bottom. 1999, that average expected return was 9.2%. 9.2%. In 2015, that average is 6.8%. 240 basis points difference. That is a humongous difference. The simple data alone that these surveys are revealing this information is a reason why we're having this conversation with a lot of clients. Now, let's look at this one other way. What we're going to do now is back into those averages, your 9.2 and your 6.8%, using a building block approach. Now, we're going to start with a risk-free asset, and we're being a little generous, I guess, when we say risk-free by using the 30-year Treasury. And why do we use 30-year Treasury for this analysis? Well, pension funds in particular, the theory of a pension fund is you fund an employee's retirement benefit over the course of his or her working lifetime. Tends to be about 30 years. So there's the rationale for why we're using 30 years. But look at 1999. The 30 years trading around 6%. Inflation is running around 2%. So that market premium, or to make up that difference between your risk-free plus inflation to get to that 9.2 average, it's simple. It's 1%. If anything, that's a conservative number. I think everyone feels pretty confident over the long term they can hit a 1%. And if not, fire investment consultant immediately. 2015, let's fast forward to the end of 2015. Now, the 30-year is trading around 2.3%. Inflation is non-existent. Your market premium is 4.5%. And I would argue for most institutional portfolios, 4.5% is still extremely realistic. But here's the difficult reconciliation. You're going from a 1% market premium to 4.5% market premium, 350 basis points higher. That's difficult. That's a difficult argument to overcome in some cases. So let's go ahead now and flip to the next chart. Capital markets. What have capital markets done? We're looking at 30 years worth of data. You're seeing 3 squiggly lines appearing on this chart. You're seeing a blue one and a red one. Those are interest rates. Yield on 10-year Treasury, yield on 30-year Treasury. The point's already been made many times today. Yields have gone down quite a bit. Fixed income prices, fixed income returns, inversely related to yields. As yields go down, prices go up, returns go up. Investing in bonds over the last 30 years has been extremely accretive for investors. The yellow line, the green line, whatever color you want to call it, that's the S&P 500 index. It traces the movement over the last 30 years. We all know there's been a lot of volatility with S&P 500. However, just look at the endpoint. It's a lot higher today than where it was 30 years ago. The point was made earlier today by Jim that S&P 500 is up 63% over 5 years. That's more than 12% a year. It's hard to digest the fact that 12% will continue every year. Let's spend a little bit more time on each one of these now, the bonds and U.S. equities, again, to support the idea of why we're here and why these conversations are taking place a lot. What we're charting here is those same two yields, 10-year Treasury, 30-year Treasury. Then we're going to put the core bonds on there, the aggregate. That's in that gold line. The trend is clear. We've already covered it a lot. The straight lines are the averages over that same time period. Yields are well below their long-term averages. Again, let's think of that inverse relationship. If yields are low, the math of bonds governs that at some point they're going to start to go up. Now, I've spent the last 8 years of my career at Marquette telling clients that interest rates are going to go up at some point, and here we are today still talking about it. But if there are any Tim Burdick clients out here, you might have heard his comment, bonds are math, the math is not good. Now, we talked about the possibility of negative rates, and sure, that could drive returns higher, but at some point it becomes unsustainable that rates keep falling. So they have to go up. Well, gee, Greg, why do you keep talking about low yields relative to their averages? Well, here we're going to chart some information. We're going to chart the yield on the 10-year treasury on January 1st of each one of these years. That's going to show up here in the red. Okay, so we rewound the clock 20 years, 1996. January 1st of each one of those, what's the prevailing yield? Then, what is that subsequent 10-year return? Look at those bars. They're almost the exact same height. I'm an actuary. Sometimes I can't help myself with numbers. I promise not to hit you with too many of them. But correlation between these, 87%. Okay? Yields are really low today. Chances are returns are going to be pretty disappointing going forward. What about the equity market, you say? We're going to look at one particular valuation metric in the S&P 500 index, price-to-earnings ratio. I could just have easily chosen dividend yield, price-to-book ratio. This is the movement of price-to-earnings ratio. And now we're going to chart the average. That's the straight blue line. I stood up here on the same podium last year and talked about trying to gauge future market direction based upon prevailing current valuation metrics. Now, it's not a perfect relationship. Don't go bet your house on the fact that the PE ratios are elevated, so the market's going to come down. Again, that's another conversation we've been having with clients for a long time. The markets continue to prove us wrong. But chances are that the market, as I mentioned earlier, is not going to support 12% every year in perpetuity going forward. Takeaway here, equity returns are expected to be subdued in the coming years. So what does all this mean? What we're going to see here, we're going to chart the movement of the expected returns of three primary indices in capital markets. We're going to look at bonds in the blue, again, that's your ag. We're going to look at S&P 500, your U.S. equities in the red, and then your international equities in the yellow. This is the output of our asset allocation software. I'm not here to sell you on the merits of our asset allocation software, but it responds to changes in the economic environment, expectations of markets going forward. I'd encourage you not to focus on the starting and ending numbers, but look at the general trend of each one of these indices. They've come down quite a bit. Again, not a shock to anyone, especially given the data we've just reviewed. But taking all this together, clearly, supporting the expected rate of return you used to have, say, 10 years ago, 15 years ago, is a much more difficult task today. And towards that end, right now, we're going to look at, again, we're doing a lot of rewinding today, going back in time. We're going to look at a portfolio as of January 1st, 2006, what a portfolio would look like to hit a 7.5% target rate of return. We've kept the ingredients here, the asset classes, pretty vanilla. Point being, we wanted to look at portfolios that just about every investor can participate in. So there's not a lot of private equity in here. There's not a lot of real estate in here. Let's just kind of keep it to stocks and bonds. There's your 7.5% target rate of return. Your volatility is about 8.9%. Look at the base layer here, 35% core bonds. I think most institutional investors could be pretty comfortable with that. There's another 10% there of fixed income. It's high yield, so we could argue whether that's more equity-like or more fixed income-like. But point is, 35%, I think that's a portfolio most people could be comfortable with. We run this same portfolio today through our software. It's 6.1%, not close to that 7.5%. And if we could take a step back, and you're probably tired of hearing about Marquette's asset allocation software, we could run any set of assumptions you can get from a JP Morgan, from a Goldman Sachs, from another investment consultant. The resultant trend is still the same. It's very difficult to support those higher rates of return that we're used to seeing. So that brings us to the choice. Here are two choices. We can reduce our target rate of return. So some clients may be very comfortable with the portfolio and asset allocation they have. They may be comfortable with the volatility profile they have. Well, if that's the case, and given all the data we've seen, a conversation around reducing that target rate of return is probably likely. The other option, of course, is, you know what, we have to keep 7.5%. We really like that number. That's fine, but it's going to change the composition of your portfolio. We just saw the portfolio that worked in 2006 doesn't work in 2016 for a 7.5% target rate of return. Let's review the implications then of each one of these because, like I said, both of these present some challenges. What we're going to do here, and I apologize for the focus on pension focus here, but I think this is particularly insightful to the idea of reducing your target rate of return. Let's look at a pension fund that has $400 million of assets, $500 million of liabilities, and using an 8%, a static 8% to value liabilities. The funding ratio, 80%. I think most people here today with a pension fund would be happy enough with 80%. Okay? I know there's some pension funds that would love to have 80%. But now, given today's environment, we have to drop that target rate of return. 8% can't support it. We like our asset allocation. We like that volatility profile. We're not comfortable taking on more volatility. We're going to drop the target rate of return. That means we have to drop the discount rate. We're going to drop it to 1%, 7%. Okay? While the duration of the liabilities, meaning the sensitivity of the liabilities to interest rate changes, well, that's going to drive your liabilities higher. So now your liabilities jump to $560 million, funding ratio 71%, okay? That's a pretty meaningful impact. Let's look at the other option now. Let's look at, you know what, we like 7.5%. We're willing to take on some more risk. How does that portfolio look? This will build behind me. Right off the bat, 35%, 10%. Now you have 10% conservative fixed income, core fixed income. We'll give you another 10% in high yield. But the point is, suddenly, that conservative anchor of your portfolio has been reduced quite a bit. Now, the red really drives home the point of increased volatility. Before, you were 8.9%. Now you're at 13 and change. I can't read, it's blurry. But the math of that, you're 50% higher. Your volatility is 50% higher to get an extra 140 basis points of return. That's a tough trade-off for a lot of people. Okay? We want to make sure that all of our clients go into this wide open. Like I said, neither option is perfect. We want to make sure that every one of our clients understands the options and implications. Now, let's look at volatility one other way for a portfolio. Here we're going to look at a $100 million portfolio, and we're going to look at value at risk over a one-year period. We're going to do 95% VAR, as the math nerds like me like to call it. You're the bottom 5% of returns over a number of different simulations, a number of different possible outcomes. You know, we'll run 10,000 possible outcomes. The bottom 5% of returns, what happens to your portfolio if you're in that bottom 5% over 1 year? In 2006, your value at risk, what you could lose, is $5.3 million. So you're down to $94.7 million. Now, keep in mind, we've ramped up the volatility now to hit that 7.5%. Now we're looking at a value at risk, $12.8 million. That's a 142% increase value at risk. That's a much tougher pill to swallow, especially when you're thinking about a one-year period and all the negative consequences of losing that much money in 1 year. Again, not a pretty picture, but it's really choosing the lesser of two evils here. I think a very fair question at this point is, well, are there any other options out there? What can we do to improve our return without perhaps quite as much risk? Here, another portfolio is going to build behind me. A lot of you who work with us, who've worked with us for a number of years, probably have alternatives in your portfolio. So the idea of using alternatives is nothing earth-shattering. What we want to do here is illustrate some of the merits of alternatives. We've just used real estate here. Real estate, I think, of all the alternative options out there, the easiest to understand, probably the most accessible, and quite frankly, probably the most widely utilized across our client base. We're just going to put 10% in real estate here, take some of the equity risk off the table. Well, your return's gone up a little bit, your volatility's gone down a bit. So that's certainly a movement in the right direction. In terms of how much alternatives each portfolio can handle, that's going to be a customized solution because for a very poorly funded pension fund, you have to trade that off with liquidity, and if you have a large market correction, you have 40% in illiquids, well, your portfolio is pretty much shot. So it's going to be a series of trade-offs for your portfolio. I think E and F's are in a little bit more of a favorable space there in terms of being able to do more alternatives. So, other thoughts, final thoughts. Well, we talked about the liquidity issue, and that's the liquidity, of course, and illiquidity of alternative assets is something that committees need to balance. The second one, particularly for pension funds, there's an emerging trend of annuitization in the pension fund world. That's why I say future destination of your plan. Plans that are frozen, plans that are closed. What we're starting to see is those plan sponsors and those committees, not the committees, but the plan sponsors and organizations selling their liabilities to an insurance company, okay? The insurance company then assumes all the risk and all the liabilities. Now, the insurance company is going to work you real hard on how much you have to pay to do that, but the risk is off your books. The reason I say that, this is going to play into the rate of return and really the longevity and investment horizon of your plan. The last three together deal with timing and time horizon. So we've been in this low rate environment for 7 or 8 years now. Certainly challenging. But I can promise you, because I am one, a lot of the actuaries who look at these rate of return assumptions, they look at a 30 and 40-year basis. And I mentioned earlier that the institutional world, I think, is subject to a lot of trends and having to kind of feel this obligation to follow what everyone else is doing. And we're not saying don't follow everyone else, but we're also encouraging our clients to think longer term, okay? And I think a 25 to 50 basis point adjustment in target rates of return based on some of these factors and the unique circumstances of each client makes sense. It's certainly justified. But we're really trying to work with our clients on encourage them not to go overboard and keep some perspective and some time horizon in mind as we go through this. Because after all, just about every one of your funds are perpetual or darn close to perpetual in nature. So let's just keep that in perspective. We're here to answer the question, is my return target realistic? And it's not a comfortable answer for us as investment consultants to give you, because unfortunately, there's one negative consequence or another. If you drop your target rate of return, your liabilities and contributions are probably going up. Or you maintain your target rate of return, but you're probably looking at higher volatility. It really is up to each particular committee to assess their own risks, their own goals, work with the investment consultant, work with the research group here to really identify that best answer. I hope this has been insightful for you. Thank you very much.